the goal that you're trying to get
Yeah.
to with your, and that's for me. I think
Location fits into it. So the long and the short of it is.
absolutely. How about at the end?
What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Fashionably late or unfashionably late, it's your choice. I do apologize for my tardiness today. I was just whipping together some data points, which I'm going to share with you on Australian property writ large today. We're going to talk about property in today's Rask Invest live show. If you can hear me, say good day. If you can't hear me, well, you probably can't hear me, but I hope you can. So jump on. Let me know if you're on YouTube, if you're on Facebook. I'd love to know I'm just not talking to myself, which I do from time to time, but it would be good. It would be good. So say good day. And while that's happening, I'll make sure everything's right from my end and get all my slides ready to go. Happy days. Looks like I am in business. So I can see a few folks have dialed in already, which is great to see. So today we're going to be talking about property. Fallen down. Can hear you. Thank you. We're talking about property, and in particular, we're going to talk about everything that comes with using property to create wealth in Australia. Now, this is the fifth and final installment of our foundational series. So for those of you that have just tuned in for the first time, we go live every Thursday at midday. But these first 5 episodes that we're airing as part of this new Rask Invest live series are all about the foundations, so that in 1, 3, 5, or 10 years from today, we can refer back to them and we can say, go back to that episode. That's the one that teaches you the thing which you should know before you go down this path. And I should do a special shout out to our partners. Our partners, of course, who you may know, and I'll bring up the screen here, are Navexa, Perla, Pocketsmith, and Superguide. These are the main brands that you will see me bring up each and every week on the Rask Invest live show. We'll probably have more join us in time, let's be honest. But a lot of the topics and a lot of the guests and features that we have over time will involve all of these brands. Let's just quickly go through them. So Superguide is this wonderful and really cost-effective. By the way, these aren't commercial partners, so we don't make anything from this, but I just wanted to let you know. This is a platform where you can go and learn about superannuation and retirement. Doesn't matter if you're younger or older. It's got great, absolutely wonderful resources. Navexa is the platform that we're actually using to build our fake news portfolio together here on the Rask Invest live show. So we put a million of our fake Navexa dollars, let's call them fake dollars, or Navexa dollars makes sense, into the AAA ETF. We are going to build this ETF portfolio. And it's not an ETF portfolio, it's just a fund portfolio starting again next week. So next week, we do it every month. We add some positions to the fake news portfolio. So that'll come up next week. You can use Navexa to track your portfolio. Perla is a long-term ETF and share investing platform, but is predominantly used by share investors who like automation. Pocketsmith is the new tool that I'm using for my personal finances, and it can track your budgeting. It can actually forecast your budgeting as well and where your wealth might be, which is really cool. So check that out. It also can sync with everything. So it can sync with different bank accounts. It can sync, I think it syncs with Perla and these types of like different platforms, ComSec, whatever brokerage platform you're using. And of course, Rask Invest, which is the investment service that we run here at Rask. And here's a little sneak peek. So the portfolios that we build for our fake news portfolio are not the actual portfolios that I run. There is just a bit of fun. So keep that in mind. Rask Invest is the real stuff, but the fake news portfolio is a bit of fun that you and I are going to build together. So next week's session, be sure to send me some ideas, drop them in the comments for things that we could review, stocks, ETFs, active funds, whatever that we can track through Navexa. We can start allocating some serious dollars to. And if you don't know the rules of the game, we're going to build this portfolio together over the next year, and then we're going to set it free, and we're going to track it over the next few years. And then we're going to build another one next year and then set it free and just see which one does better and have a bit of fun as we go. So unfortunately, I don't think that we can put a property straight into this, but we could put a property ETF. Actually, you may be able to pop a property straight into it, but like you may be able to track a property through there. But if you've got like the VAP ETF, this is an example of something that we can track through time. But anyway, let's get on with property. I see a few of you in the chat already. G'day, Caroline. Gavir, good to see you. I know you've been dropping a lot of questions into the Rask community about property, so this will be fun. Justin, pleasure. Samantha, hello. Tim, love listening to you ramble on about finance. It gets me through my long driving hours. Well, thanks, mate. Just as long as you're not, if you're driving, unless you got like a Tesla or something where it's on autopilot, make sure you keep your eyes on the road, mate. Mr. Leftovers, good to see you again. If you are inheriting a property but currently living in it with your parents, is it better to purchase another property to live in or invest the remaining funds in the stock market? We'll talk about this in the future. Sir Dino, how long do you hold your shares for? As long as I possibly can is the short answer to that. With these portfolios that we're building together, I'm guessing that like we're going to track them over the next 3 to 5 years together. So if that's any indication, like once we build these fake portfolios together, after a year, we'll just occasionally check in with them, but we're not going to actively update them because we're going to build a new one every year. It's just a bit of fun. But actually, the actual investments that I make, I don't think anything under 5 years is like, if anyone says that they invest for 3 years, I actually don't think that they're investors. I think they're traders, and it's a different. I think an investment has to be a minimum of 5 years. At least that's how I approach it. I think for property, it has to be longer than that, to be honest with you. So let's get into it. As usual, start with a quote. Buying a house is usually a lousy investment. That's a quote from Warren Buffett from quite a few years ago now, where he was asked about property. We are going to wrap some context around this. So let's not hate on Mr. Warren Buffett just yet, the world's best investor, obviously. But some of you may know that I sent out an email this morning to promote today's live show. And one of the things that I did, and I had to call up an analyst friend of mine. I was on the phone to him actually as I was calculating this. I was like, mate, does this sound right to you? Because apparently the same house that Warren Buffett has lived in Omaha, Nebraska, he's been living in since 1958. I was digging up and finding some things on the internet of all places, which is super reliable, as we know. But he's lived in the same house. I think it's on Farnham Street. And it's estimated to be worth about 1.5 million, give or take. But his net worth is $143 billion. So I, speaking to my mate, I was like, mate, does this sound about right? Here's my calculation. He's like, all I know is there's a lot of zeros. And Warren Buffett's actual house and his portfolio, so if he was retiring on his portfolio of property, it's worth 0.01% of his assets. And I thought to myself, that seems a very small number indeed. 0.01? So then I was like, come on, I need to get a second opinion on this, or a third opinion. So I went to my good friend ChatGPT and I said, what is 1.4 million divided by 143 billion? And it gave me the wonderful formulas. And they said approximately 0.000979%. So that's very different to most Aussies who retire with most of their money in a property. But that's Buffett. So anyway, have you subscribed to the live show? I hope so. We go live every Thursday. Don't forget the general advice warning. When I use the words Rask Invest, that's the name of our investment platform, but it also has a product disclosure statement and a TMD, which you can get on the website. But also, it's also the name of our live show. So it's a bit confusing, but Rask Invest, because we want people to know it's about investing and it's from us. So I hope that makes sense. But anything that I do answer in the questions, because we'll get to plenty of these, just know that I can only give general financial information only. If you want one-on-one financial planning advice or one-on-one advice, go see a mortgage broker, your tax accountant, or a financial planner, or even a lawyer if you're talking about like structuring a property into different assets, into different structures. I did do a guide the other day, which I'll pop in the show notes now. And this has been super popular already, one of our most popular guides that we've done. But this guide on the Rask Media website is all about how do you sell a property investment allocation that you might have, and we'll talk about this today, and then transition that into more passive income streams. So how do you use the wealth that you create in property to create wealth for you in retirement? And we'll talk about that. But this guide that I just put in the chat covers all of that stuff, including the primary different options that you have available to you. So Let's move on from the disclaimer. We do this every Thursday. You know the drill. You can also continue the conversation over in the Rask community, which is just where Gavir was the other day. Community.rask.com.au. You can, like, there's a post for today. You can jump in there. You can chat with the Rask podcast host. You can ask questions. You can do all this sort of stuff. It's a wonderful community. On today's agenda, why you should consider using property with your wealth, the performance of it and how to think about it, how to use debt wisely. So we'll touch a little bit on debt recycling, which is, I know, what a lot of people want to talk about right now. Equity release, which is slightly different, but it's basically the same process. We'll talk about lifestyle assets of a property owner versus a renter. We'll talk about the supply-demand imbalance, and then we'll talk about what happens after property. Like, how do you use property to your advantage at one stage of your life, and then how do you use it in another way at another stage of your life? And I'll take your questions as we go through, folks, so please send them in. You can start sending them in now, so then I can answer them throughout the show. So let's talk about property as a kind of like an overall asset class. So property, and by the way, guys, and gals, I'm going to be referring to this type of chart that looks like this. These charts come from Trading Economics, which is an absolutely wonderful website. They pull data in from different sources like the Bureau of Statistics, the World Bank, different types of sources, and then they make it digestible for you. So Trading Economics is a great website. Full credit to them for these charts. So property performance. Let's talk about residential property, otherwise known as resi. Most people in Australia, rather than, which is typical overseas, most people in Australia think about property in a very one-dimensional way. They just think about residential property, the house that people live in. That's what people think. I'll explain to you why that is not the only option. And I know a couple of people in the chat here who have talked to me about investing in the past may own property outside of what this is, but we'll come to that in a minute. Residential property in Australia has performed exceptionally well over the long term. Depending on your data source at the moment, the average Australian property is about $930,000. If you live in Derby, WA, I'm sure the houses are cheaper than they are in Darling Point, Sydney. And what we've seen over the past few years is obviously capital cities always reign supreme when it comes to property prices basically anywhere in the world. But one of the things that's quite interesting that we've seen in the last 3 years is a mix in the way Australian property prices have moved. The big cities, being Sydney and Melbourne, have kind of cooled. When you think about percentage terms, the percentage growth rate has kind of cooled off for the last little while the next level of major cities, so Brisbane in particular, has surpassed Melbourne. But the other two cities, being Adelaide and Perth, have really taken off over the past few years. And that's because of investment. It's because of people changing the way that they go. It's because of the resources boom in WA. A lot of different factors are coming into the mix, but that's generally what we're seeing taking place. A lot of investors on the East Coast can't afford to buy an investment property here. A few years ago, they were buying in Brisbane, but now they're buying in Perth. These types of things. This is something that on the Australian Property Podcast with Pete Wargent, Chris Bates, and Amy Lunardi, this is something that they cover each and every week. So Chris, being Australia's #1 mortgage broker, and Pete, who's written like however many books Pete's written now, every Sunday morning they tackle the big property topics, and Amy, and less than extent myself, share our journey and stories over time. But they talk about this all the time. They talk about the shift in the kind of the way Australians view property and how that's going over time. So now, what about the other types of property that you could invest in? So we just saw that obviously residential property has done this since 2010. It's actually, if you go back to the 1990, it's actually done even better again. And your parents tell you and your grandparents tell you how they bought their property for $470 and all that sort of stuff. Over the long term, we can also measure property performance, not just through residential property, but also through real estate investment trusts, which include things like warehouses, office properties, these type industrial properties, like all different types of stuff, right? And you can measure these on the stock market, because on the stock market is where you can invest in these things called real estate investment trusts, or REIT, real estate investment trusts. And you can even buy an ETF that then invests in REITs, that then invests in property. So you got like multiple layers, but you can now invest in these things using your brokerage account. This is kind of, for some people, it's novel. For most of us, it's quite old news. But the reality is that you don't just have to invest in housing. You can invest in basically any type of property that you want. And we call that commercial property, office property, industrial property, that type of a thing. And you don't have to, as popular as those TikTok videos and those things you might see on the news are, you don't have to go and buy an actual warehouse. You can just use something that's available inside your brokerage account and invest $500. You don't need $500,000. But anyway, over the long term, if we measure the performance of these types of investments as an indicator of property performance, you can see that Australian property, according to the Vanguard Index volatility charts, has returned about 8.5% per year. That is slightly less than Australian shares. So this is from January 1990 through to basically the current time. You can see that US shares have outperformed everything, but property has still performed very, very well at 8.5%. Now, many of you will know that this is not an apples. This is the apples to apples comparison. This is comparing the percentage performance of share investments versus property investments, right? However, a few things to keep in mind here. Number one, this is not a true indication of every house. So my house, your house, it's all different. It depends on the suburb, the street, the type of property, the land value versus the property value, all different types of things. This is the average over the long term. Same with the share market average over the long term. But the real thing that this number right here, I'll bring up red, the real thing that this number does not capture is actually the leverage or the debt that can be used against property. So this is like a apples to apples comparison because both of these numbers, Australian shares and property, are not factoring debt, which we'll come back to in a moment. But as we can see, it's performed very well. One of the things that's quite interesting to me is people say property doubles every 7 years. And I just thought it was an interesting little exercise what that might actually look like. If we think that the average property in Australia, this was for March 2024, it's a bit skewed in the data, but it says 960,000. It's 930 to 960,000. But say the property price today on average is 960,000. What someone who believes in this lovely fairy tale would tell you is that in 2034, the average price will be this. People in Sydney are probably already paying that, to be honest. Then this, then this. So, yeah, I mean, anything's possible, but is it a reality? I don't know if it is. So I actually don't know if it is. I'll let you make your own opinions of that, but that's just the basic math. Tim, you've said, hypothetically, if you invest into VAP, can you then call yourself a commercial property investor? I'm sure you could. I'm sure you could. Just for coffee table chats, yeah, I'm sure you could, mate. So if you did use something like VAP, which is the Property Securities ETF, so let's just explain for people that are watching at home how this works. So you basically have an ETF, which is like a basket. Look at this basket. Wow. Look at this. This is my attempt at a basket. So this is the ETF. The ETF owns a REIT. Let's just draw a bucket. So a REIT is just like it's called a legal trust. So REIT, and that REIT owns, look at this, it owns the office properties, it owns the shopping centers that you go to, it owns all that. So it actually owns the properties. And so this, which is VAP in this instance, that's the ETF that we're looking at. That one owns all of these different, we'll look at it. That ETF owns portfolio. That owns 33 different REITs or different property related things. So 33. And then within that, it owns, within that, we'll have a look at one of these things. So let's take, it owns, let's say there's Goodman Group. Let's say there's Center Group. So Center's the This owns the Westfield Shopping Centre properties. So not the business, the properties. But let's have a look at this. So we can see all these different things in here. Why don't we take one of these random things? Why don't we take... Actually, there's one that people might be familiar with, which is not shown here, which is BWP Trust. So BWP Trust is a REIT. So we'll go back to our chart. Let's say we use BWP as an example of a REIT. This is a REIT that owns the buildings which Bunnings warehouses are found in. So some of those warehouses that you go to on the weekends, there's the Hawthorn one in Melbourne. I used to go there. What it actually owns is it owns 82 properties worth $4 billion. So effectively, it owns 82 properties. And this is not the biggest REIT. There's so many bigger REITs than this. So by buying the ETF, you own 33 different REITs or different types of property investments. And then one of those owns 82 properties worth $4 billion. So in effect, Tim, I reckon you could call yourself, sure, you don't own the properties directly, but you've got multiple layers there. You're probably the big dog when you sit around the coffee table and talk about it, to be honest, mate. So there you go. Now, let's ask ourselves, if Warren Buffett's telling us it's a lousy investment, and there are probably a few reasons why he says it's lousy, but we can come back to that. But if he's telling us it's a lousy investment, why do we see property prices going up so goddamn fast? I think there are a few major economic reasons why Australian properties are going up super fast. And you've probably heard these before, but let's just look at them. Let's just see them in reality. Okay, let's talk about the first thing. And this is probably the most important, so I'll come back to this. Wages. The average wage in Australia, as you can see right here, according to ABS data through Trading Economics website, is $1,500 a week. If you go back to, say, this point right here, which looks like it's about 1983, people were making $300 a week. Nowadays, well, if you work for a CFMEU place, you're probably getting that every minute. But the reality is, I joke, is that most people's wages have gone way up. And, if the average wage is, say, $80,000 a year, obviously they're skewed to higher numbers than there are lower numbers, and it's the working age population, blah, 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 blah. You get the point. Right? So if you're, say, earning $80,000 a year, a rough rule of thumb amongst mortgage brokers is you can get from the bank about 4 to 5 times your annual salary in a loan. So in this instance, someone like that could potentially get $400,000 to $500,000 in a loan, say, but they've probably got a deposit there, so they'll have a little bit more in terms of the actual property value. And if there are two of them in the couple that are buying a house, well, then the bank can lend you even more money. So that's how you can justify how prices get up to a certain extent. Now, I'll come back to you in just a moment. But general gist here, ladies and gents, wages are going up. Therefore, more people can borrow more money. Speaking of more people, if we go back to the number of people that live in this great country of ours, we can see the population clock is fast approaching 28 million people. This is again through ABS data via Trading Economics. Now, what you can see here is almost a beautiful replica of the average wages. So not only are people getting paid more, there's also more of us, which means more of us are getting the ability to get more in loans. That sounds like it's really good for the banks. This gentleman here is one of the most well-known and recognizable finance people probably Australia has ever produced. This is Paul Clitheroe. I was very humbled to sit down with Paul the other day, and for Rask, of course, and he just has this knack for breaking down really complex topics. Let's go Paul Clitheroe. If I can spell podcast, look at that. Let's actually make it legit. So here we can see Paul and I having a bit of a about property, and I'll put this link in the show notes here for you, in the chat, so you can watch it at your own leisure. Get rid of this stupid ad. But in this podcast, Paul, it's going to ask me for ads. Yeah, whatever. No worries. Cheers. Paul talks about these things called little economic miracles. And he says he will be bullish on Australian property for as long as the economic miracles keep being miracles. Now, what he is talking about is he's talking about people like you and me. We are economic miracles. And the reason is he's saying there's more people in Australia earning more money, which means more things are going to happen in the economy. And that means that people will be able to afford more properties. There was a famous, I heard a story about one of Paul's presentations that he did to a bunch of investors years ago. Paul is the current chairman of InvestSmart, by the way. He did this presentation, and what he actually did is he didn't prepare any notes. He didn't prepare any slides other than one slide. And the slide that he had was this one. This exact chart is all he had. And he just put it up on the screen, and then he went and stood in front of all these people. And I think about that all the time. I think about this says what property investors need to know. More people earning more money. That's Australia, right? So let's have a look at actually how those two things mix together. So we've got more people earning more wages, which means more growth in the actual economy. More cups of coffee, more people buying cars, more people going on holidays to Byron Bay, more people going to visit the Quokkas over in WA. You know, I'm trying to think of examples. Hobart, you can go to the Winer regions, or maybe in SA, you're going up to the Barossa Valley. I prefer the McLaren Vale, to be honest. Like that's more my vibe. But anyway, basically, more people doing more things, earning more money equals better economy. You see that there. Let's keep going down. So why might property prices be going through the roof? This is Associate Professor Sam Wiley. He's an associate professor at Melbourne Business School, although I think he resides in WA. Sam has come on our podcasts at Rask once before, and we might have him back on again in the future if we're lucky. Sam recently put this thing out. It was only a day ago. He put this chart up on his LinkedIn profile. And you can see here, he draws this line and he's showing housing approvals per 1,000 population. And what you can see is since 1983, which is over here, through to this month, which is here, the trend is, and I'll draw over the top of his line, massively down. Fewer housing approvals. Think about this for a second. Fewer houses, more people with more money equals house prices going up. Anytime someone comes to you and acts like they're a genius for picking a property that goes up in price, just remind them of this like elementary mathematics. The reason that property prices have gone up, not enough houses, more people. That's it. That's as simple as that, right? Dress it up however you want. You can buy a good property, you can renovate it, do whatever, but that's the reality. That's all it is. Now, fair enough to you if you have done that, and great, because that's what we're going to talk about. Like, it is what it is. And despite all these politicians doing what they do on the TV every night, the reality is we ain't building enough houses. And there are many reasons. You can blame the CFMEU for being corrupt. You can blame your local council for being snobs. You can blame your next door neighbor for saying no to your housing development. You can do whatever you want. But the reality is we're just not building enough houses. And unless we figure out a way to build more housing, we're not going to see a more balanced economy when it comes to property. You can tax people, you can do whatever, but then that just stops people investing in them. So then it relies on the government to build more houses. But if the government can't build houses because of all the reasons that I just mentioned, then, well, property price is going to keep going up. And so this is the actual reality. Fewer houses, more people, more money, and, you know, so long. Like Sam actually went in his LinkedIn post. He does actually go in to explain some of the complicated reasons why we might not see a bottleneck. One of the things that he kind of concludes with this chart is that instead of seeing the chart continue down, as in like fewer houses again being built, is he suggests that maybe instead of going down, like keep going, that's a bit dramatic. Instead of going down like this, he's suggesting maybe what happens is it kind of goes like this and it just kind of plateaus. So fewer houses being built, but a stabilization in that. So let's continue on. Let's talk about gearing. And I'll use the analogy of a amplifier. In this case, that looks like a guitar amplifier, or if you're a singer or whatever. I mentioned before how this calculation was an apples to apples calculation. When most people think about property, they think, and most people think about anything really, they think about percentages, like how much did you make in percentage? You'll probably go back to return on investment and you think 50% return on investment or whatever the case. But when people think about property, typically they measure it in dollars. I bought it for this, I sold it for that. And a big thing that comes in with property versus, say, shares is, let's say, for example, you have $100,000. Let's say, yeah, you've got $100,000, and I'll do it slightly smaller. So this is your $100,000 that you've got sitting in your bank account right now, $100,000, and you say to yourself, I could go and put that in, I don't know, an ETF. Let's pick one. Let's go to Perla, and let's say we've got like the most popular ETF in Australia, which is the VAS ETF. It's also an ETF that we hold in our Rask Invest portfolios. If I go to holdings, you can see it's down here at the bottom, right? So let's say you put $100,000 in that, and let's say it returns 7%. So if we just say 7% for round figures, in a year from now, we'll have a $7,000 profit, right? And this is, I know this is pretty self-explanatory for some people, but let's just keep going. Now let's say we take that $100,000 and we go and buy a house near the Quokkas over in WA, and let's say we can get that house with our $100,000 deposit. It's a $500,000 house. So now we've got a $500,000 house. So this would be effectively $400,000 from the bank, and we've still got the $100,000 down the bottom for a grand total of $500,000. Now, if we assume a 7% return on our property, we're not getting $7,000. We're getting 7% of $500,000. Don't think about the debt for a second, which is $35,000. So now we've got the same amount of money. All we've done is we've just plugged it into something called CBA or NAB or whatever, a bank, a loan. We've plugged it in and we've said, check this out. And I like to use the example of an amplifier, because basically, if you're horrible at playing the guitar, don't mess around with an amplifier, because everyone will know you'll look like a complete fool. If you're good at playing the guitar, give it a crack. Bring it on. It's the same thing with debt. If you don't know what you're doing, do not mess with it, because you will blow yourself up. But if you are prudent with it, you can use it to extraordinary effect. And this is an example of why leverage where leverage can be really good. Obviously, it can work the other way as well. But this very simple idea is the reason why people who buy property get ahead faster than people who just buy shares. It's debt, and everything has gone up. If it went down, everyone would look like idiots, but it's gone up. So that's the basic gist of it all. Now, what's this one here from Johan? What about apartment investment in Melbourne? Despite all these promising market indicators and great location, not capital growth, negative 2% over the last 10 years. Should I keep it another 10 years? Well, I can show you something. SQM house prices. Let me just bring this up one sec. Here we go. I'm trying to find. I think we'll even show this here. Yeah. So what this shows shows it in a different way. So what this is showing for postcode 2000, which I think is Sydney, what this is showing is over time the rental yield that comes from different types of dwellings. You can't really see it over here, but this purpley line is actually a unit. So what we typically find with units or apartments is they're higher income, but much lower growth. That's typical. It's not always the case, but that's typical. And so what the way to think about this is, and on our property podcast, Amy and Pete talk about this a lot, is that if we have, say we have, for very round figures, right? Say we have a $1 million property, $1 million, right? There's a thing called land value. So land value, what typically you see is properties that perform really well, about 60 to 70% of that value of the overall selling price is for the land value. So because houses, like the house that I'm in right now, if I hit on the windowsill, in 20 years, this windowsill is going to need to be replaced. I can tell you that because it's already about 10 years old. So unless I maintain the bejesus out of it, it's going to depreciate. But the land outside is going to get more valuable. So the land is what will continue to power the value of this entire house. I live in a weatherboard shack. I bought a house with lots of land value and low property value for this very reason. Now, if you think about this with an apartment or a unit, it's actually the opposite. You don't have any land value, really. You're basically there is some implied land value. You don't actually have physical land under your feet, but you have a space. And the banks know this as well. This is why when you have a property that has higher land value as a percentage of its overall property value, this is why you can get a bigger loan for these. So if you think about buying a property or holding an asset, you want something that's going to appreciate as quickly as possible if your goal is long-term wealth creation. So that's why houses tend to perform better than apartments. It's also why apartments tend to have a higher yield, because if an investor buys them and they're not going to get the growth that they could get from a property, like a house, they will demand a higher rental return to make up for that. Another thing that happens with this, Johan, is the key point with buying property is this. If I sell you, let's say I sell you my BHP shares. I don't own BHP. Let's say I did. If I went into my Perla account or Comsec or whatever the heck you're using, and I said, hey, Johan, can you buy these BHP shares from me? And then let's say Kevin in the chat here. Kevin says, oh, I've also got BHP. Do you want to buy mine? It wouldn't matter whose BHP shares you buy because they're exactly the same. But let's say, for example, Kevin comes with his house. I'm assuming Kevin's is probably better than mine, to be honest. And I come with my house to you. And I say, hey, we both say, hey, do you want to buy a house? You would say, well, let's have a look at them. They're different, right? So each house is different. Whereas in shares, they're all the same. It doesn't matter. They're commodities. They're fungible. It doesn't matter, right? So what makes a house unique is that it's unique. And you can really add some extra value just by being really discerning in what you look for. Now let's look at an apartment. If I buy an apartment in Melbourne in the same building as you, in that example, I could sell you the apartment. Kevin could also sell you the apartment in the same building. It wouldn't matter whose apartment you buy. There might be a bit of like north-facing afternoon sun, views of the ocean, who knows? But the reality is they're more like shares than they are like a unique individual house. And so that is another reason why houses tend to go up more in time versus apartments. Because apartments, what happens is if they go up too quickly in price, a property developer will just build a new apartment building next door. And so the old apartments are worth less. That's why, again, we see houses outperforming apartments. Now, I don't know the actual circumstances here, Johan, with your apartment. So it'd be best to speak to like a buyer's agent or someone, even the valuer who comes in, and talk to them about what they're seeing. You can request a valuation report yourself as a landlord, and the banks will get them done every time you refinance anyway, so you can see the data for yourself. Okay, so the basic idea with this is that gearing is actually a superpower for people that use it correctly. For people that don't use it correctly, you shouldn't be using it. Warren Buffett has this Warren Buffett's normally very polite, very grandfatherly, kind of very educational. But he has this one quip, which he says, which is that people who are smart do not need debt. People who aren't smart should not use it. And it's kind of an inversion that if you are an investor, you don't need to use loans, you don't need to use debt if you just want to get ahead. Now, obviously, Mr. Buffett grew up in a different time where you can't even buy an average Australian house for your family without some debt. You do need it, it's a reality. And once you get it, you can use it sensibly. Now, I'm going to introduce you to a topic, and some of you may or may not be familiar with this, but there's a question here from Sachin which says, if you are getting 7% growth on your property and you end up paying 6% in interest and another 1% in property management, aren't you losing money? Whereas in shares, you take home all the growth. Yes, that is a good point, Sachin. So I will come back to this. So in this example, if we were to get a 7% return on this one here, and you've got a 6% loan and 1%, so we'd subtract those, and 1% in management fees, you're coming out with zero, right? But here's the difference, Sachin, is that once all is said and done, you now own a property worth $535,000 if it goes up 7%. Yeah, sure, you've paid this in the meantime, right? But thanks to the wonders of Australian taxation law, you can actually take this, some of this at least, you can take this and you can write it off against your salary. Hence why people talk about something called negative gearing. So if this was an investment property, now this is a home loan, it's different because it's not tax deductible, which I'm about to talk about. So let's say, for example, we talk about debt recycling. Now, this is where you need to speak to a good accountant and mortgage broker. I'm also going to do something called debt recycling, and I'm also going to do something called equity release. Right, equity release. I'll just do the R, so I'll do it like that. So you know it's equity release as well. The process is same, the strategy is different. So basically what happens if we have a property worth, say, $1 million, so 1 million Rask dollars, and let's say, for example, that when we bought the property, we had to put down 1/5 or like 20%. 1/5. Who uses fractions? What am I talking about? So 20% deposit, right, is what most banks want you to get to avoid lenders' mortgage insurance. But let's say I don't know. So that would mean that this is a loan of $800,000. You brought $200,000 of your own, which is a great savings amount. Well done to you. But let's say in a few years, this $1 million house is now worth, I don't know, let's say 1.2 million. So I've kind of run out of space here, but let's say 1.2 million. So 1.2 million, right? That's a 2. Yikes. So in this instance, you've still laid down your original 200,000. So that's what we call equity. That was your money that you brought to the table. And the rest of the debt was 800,000. So this is a E for equity. This is a D for debt. Debt to equity ratio, sometimes called a loan to value ratio, because people compare this amount to this amount. That's called a loan to value ratio. So L, loan to value. I hope you get that. Okay. So in this instance, we've still got our original $200,000 deposit that we put down here. But in this instance, the rest of the property's gone up. So this is a couple years down the track. So let's say it's 3 years down the track. This is today, right? In this instance, we've got this original loan here still, but we might have paid down a little bit. Typically, you pay most of your loan. Typically, you pay most interest in the first 5 years. So you don't actually pay down the principal as fast as you think. But let's say, for example, just for round figures, all right, guys? Round figures. Let's say you get it to 750,000, right? So now what we have is we have an $850,000 loan that became 750. So it's slightly smaller. You can see that here, like in the difference between these amounts. We've still got our $200,000 of E equals equity. So we've got 200 plus 750 is the loan, which would be 950, right? That's my high school maths right there, 950. Debt, equity, but the property now is worth 1.2 million. So what we need to do is we take our 1.2 million, I'm just going to do that as that, like that, and we've got 950, right? So now we've got some money in the bank. We've got $250,000 of additional equity. This is the value of the property. This is what we contributed basically initially. So we've got 250 here in additional equity, plus the original 200 we put in. So now we've got $450,000, right? What the banks typically in Australia let you do, in this instance, if we just imagine that in year 3, we're starting again. If the original was if the house is now worth 1.2 million, and the bank sees that and they go, yeah, that's a fair valuation. That's what we would lend against. What would typically happen in this situation is you could go up to 80%. So I'm just going to bring this up. So $960,000. This is still 80%, but let's say 960,000. Just make sure I got that right. Double check. Yeah, $960,000. So what the bank is saying, 80% of the new property's price equals $960,000. We will loan you $960,000 against this property. All right. So effectively, in this instance, the person that had this, property down here and originally started with a $200,000 amount, they're saying we'll give you up to $960,000. But because there's only $750,000 available that's on the loan at the moment, there's effectively a $210,000 difference between these two numbers. So you can do something called equity release, which is where you pull this $210,000 out of the property. And that's effectively what most property investors do, is they wait for the value of their property to go up. Then they go back to their bank and say, hey, you said you would give me 80% loan back then. Would you still give me 80% loan now? Yes, we'll give you up to $960,000. So then you say, okay, well, give me a $960,000 loan, and I want the rest paid back to me. I know you're not going to give me 100% because I always need to have 20% in there, but I will want that extra money back. That's called equity release. So effectively, you're taking an additional sum out. And then you can take that money and you can do whatever you want with it, to be honest with you, to be frank. You can take that money out and you can go and invest it in shares. You could go and start a business. What most Australians do at the moment, it seems, or at least in the last 10 years, is they would take that equity and then they would go and buy another house. And they would go and do the same thing again. They would have their 20% and their 80%, and then they would build those property portfolios. In the last 3 years, however, things have got quite complicated. There's been more land taxes introduced. There's been more political kind of, oversight of people buying too many properties in one go. But basically the idea is that you slowly and incrementally buy more properties through time. Another thing that happens, which I didn't really touch on here, is that the banks now don't lend like they used to. So in the past, if we go back to this slide here, remember how I said here that based on the conversations I'm having with people and mortgage brokers and hearing from them on the Australian Property Podcast, banks are willing to lend about closer to 4 times people's annual income in a loan for a property. 10 years ago, they were willing to lend basically whatever. Like if you could fog up a mirror, you probably got a loan. It's not that anymore. So what's happened is people that have those big property portfolios in Australia, they just don't exist like they used to. And so what more people are doing these days is they have like one really good property and then they buy it and hold on to it, which is much more sensible and much less stress, if you ask me. And that's so when people come to me and they say, hey, I'm thinking I might buy this property and then buy that one using the equity there. I'm like, that sounds way too complicated. You're going to have heaps of land tax. You're going to have stamp duty on the way in. You're going to have real estate agents' fees on the way out. You're going to have tenants to deal with. You're going to have a depreciating house. Like, no thanks. Just buy one really good one and move on. So this is the idea of releasing equity from your house. The idea of debt recycling is slightly different, but it's kind of the same. Let me just explain what I mean. So the idea of debt recycling is basically that you do the same thing where you take money out of something. So let's say it's your home. So in this case, let's say you've got about 50-50. You've got a $1 million. I'm only using $1 million because it's easy to remember. But let's say you've got $1 million and 50% of it is a mortgage and 50% is sitting there in equity. Now, you know that you can take some of that money out. So what you do is you take some of that money out, let's say this chunk right here, and then what you do is you use that for investment money. Now, under the Australian law, and you could speak to your accountant about this, but here's my interpretation of what it exactly says on the ATO website, which is that if you take this money and you use this money to invest in an income-producing asset, an asset that is going to be taxed, there's a chance that the interest that you pay on this part of the loan is tax deductible. There are some good blogs about this, actually. There's one from Aussie Firebug Debt Recycling. So there's this one from Aussie Firebug, who's a financial independence blogger. There's another one from another financial independence blogger, Strong Money Australia, Debt Recycling. There's another one here from Dave Gow of Strong Money Australia, who recently appeared on the Rask podcast. And he talks through it as well. Now, don't you over leverage if you buy too many such stocks? Yes. So this is the point that I was just about to make. Great point, mate. Thank you. So what happens if you do this process? Let's say you go from this today, 3 years, your house is worth a bit more. You take out this. Really, what you've done, let's get some different color out here. Let's get this green going. I don't know where this has come from, but let's use this. Really, it might sound good, like, you know, yippee, I've got $210,000 in my bank. Really, all you're doing is you're going from $800,000 in debt to $960,000 of debt. That's what's happening here. Make no mistake. In the meantime, you're going to get some money from the bank, but that's what happened. You still got a $960,000 loan you need to repay over the next 30 years. That's just the reality of it. And so this only really works if property prices keep going up. And the reason that, and this is to Kavir's point earlier on, the reason this only really works if property prices keep going up is because the yield that you get on residential property is low. So if we go back to this chart pack from SQM, so this is for the Sydney postcode. They're saying here that they've charted it through time on just on a normal, let's get rid of all this other crap. On an average house, so like all houses, sorry, in Sydney postcode, the yield that you're going to get is like, if we look at this, it's like 2.5%, 3%. So you're going to get like 2.5% to 3% in gross yield, right? Now, if we use the Money Smart loan repayments, Money Smart, which is a wonderful website, has this really cool loan repayments calculator tool. But one of the things that they also do is they show you the average interest rate in Australia at this point in time. The average interest rate is 6.22%, according to Money Smart. So the average property in Sydney is paying 2.5% in rent before all the costs. But one of the big subtractions is 6.22% of interest rates. So you're already negative, say 4% for round figures. But this is before the tenants have called us up on a Friday night and said, hey, Gavin, I need a new air conditioner because the air conditioner broke down. And you look at it and you go, that's $4,000. And then they call you up a few weeks later and they say, oh, there's been some moisture in the floor. You're going to need to replace the tiles. That's $15,000. And then the landlord, the property manager that you're supposed to have is saying, oh, listen, I'm going to put up my fees because your tenants are annoying me. So this is before all of that sort of stuff. So another thing here, Neil, you say, but you lost 50% due to the previous 5 years inflation. Exactly. You did lose 50% because of inflation. So that's an untold thing as well. But basically, the idea is that property can be used as a great asset for creating wealth on paper, i.e. this stuff right here. But the reality is, as you get older and as you build your wealth, it no longer serves its primary purpose. And let me explain what I mean by that. What happens with life after property? Let's say, for example, you are a single or a couple, you've done really well, you've bought a property, it's gone up in price and blah, 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 blah. And now all of a sudden, in a few years, you find yourself with an investment property that's got, $500,000 of equity. You've got a little bit of a super balance. You've got a good income. What do? Well, that's why I wrote this guide earlier on this week, and why so many people have been asking me to write it. I'll pop it back in the chat again so you can open it in a new tab and save it for later. But basically what happens is when people go on their journey through life, at least the really smart, prudent people, and if this is age, let's say 18, and this is age retirement, whatever year that might be. For some people, that might be 70s. For some people, it might be 40. What we tend to see is people use property as a primary wealth vehicle early on because they can keep leveraging it up into bigger property portfolios over time, right? And then eventually, let's keep going up, Owen, like that. The bigger property portfolios over time. And sure, a lot of this would be debt, but what they can eventually do, because their negative gearing and their taxable position is really good, eventually what they go is yeah, this is our property portfolio at X date. It's right here. And this much of it, the roof, is what I owe the bank. And this much of it, which is the remaining part of the house, that's the equity. So now I'm going to sell this and I'm going to be left with this big sum of cash, right? After tax, whatever. So at this point, what do? Now, this is what financial independence people tend to do. They tend to use a lot of property to grow wealthy. But they get to a point where they start to think, I don't want a loan in retirement. I don't want a mortgage in retirement. I don't want to take that with me. So what they tend to do is they tend to slowly, over say 5 years, slowly tend to cycle out of property. And then they ask themselves, what do I do with it? What do I do with this summer cash? Now, for most people, what happens is they're left with a choice. They've got their big pile of cash. They typically go a few different ways. They would go into a superannuation fund, and that's something that I talk about in that guide. And the closer you are to retirement, the more this tends to make sense. It doesn't make sense for everyone. They might put some into ETFs, because in ETFs, like shares, if we go to someone used A200 as an example this morning when I was talking to them. So this is just a BetaShares ETF. Full disclosure, BetaShares sponsors our Australian Finance podcast. They're not paying me to say this. I'm just letting you know. So this ETF has a fee of 0.04%. If you were to invest $1 million in this, you would never even notice that fee. That's how low it is. That's what I would say. So, and all it does is it just goes and buys the top 200 Aussie shares. Over 10 years, it's returned 8.19%. Past performance not indicative of future performance and all that. But what we really want to know is this thing right here. We can see that over the last 12 months, it's paid 3.5% in a yield. And some of that's come with franking credits. Most of it has come with franking credits. So 3.5%. Now, because the fees are so low, you don't actually notice them. This whole 3.5%, it's actually slightly higher than this, don't it? This figure annoys me. But basically what they do is they say, well, I've got this big chunk of money. If I keep it in property, I'm not going to get any income because there's tenants, there's air conditioning, there's like land tax. I'm not going to get any money. What's the best alternative? Well, you probably got two. Put some of it in super and let the super fund manage it, which is a good one from a tax perspective, or stick some of it in the share market via ETFs. You could also start a business. You can do whatever you want, but ETFs. And for a good diversified ETF portfolio with some term deposits mixed in, with some, maybe some government bonds and these types of things, you can get between 3.5 and 5% in net yield a year. That's after fees, I mean. So on, say, $1 million, you're getting 35 to 50 grand plus franking credits. It's a lot better than the return you get from property that has all the costs associated with it. So this is what I mean by the life cycle. Is typically people start with a lot of property. They make use of the leverage while they've got a consistent income, and then they get to a point where they start to transition out. And it's not all or nothing. I should make that very clear. A lot of people don't just go, I'm 100% shares and then I'm 100% well, I'm 100% property than 100% shares. Isn't that would be a mistake in my view? The answer is why not just do a bit of both? And I hope that makes sense. But basically, what I see a lot of people do is they get to this point, they start to unwind their property portfolio and they start to look at other assets. So that's typically how it works. Kevin, you said, so the question I have over recycling is that using your equity has tax breaks. However, there is also significant risk if the stock market tanks or you invest it poorly. You are then risking a lifetime of debt to the bank. Therefore, you need to be a knowledgeable investor for this risk, in my opinion. That's a good point, Kevin. Thank you for saying that. So basically, thanks to the advent of ETFs, effectively what people had to do in the past, right, Kevin, and for everyone watching, is typically if you had this amount of money, and it was a big amount of money that you've worked so hard and smart with for the last 20 years, what people would have to do is they would have to go and build a portfolio of, say, like 20 shares, like CBA, BHP, AMP, not that I would ever own that thing. You get the idea, right? And they would have to do this with a stockbroker or a financial advisor 20, 30 years ago who was deeply conflicted and not worth their space. So they would end up with a crappy experience. And if they tried to do it themselves on the early versions of E-Trade or of ComSec, they would just get it horribly wrong. They would read the financial review or listen to some bloody guru on the radio who would spruik some crappy stock, and it would be horrible for them. Now it's very different. The finance industry is extremely well regulated, for better or for worse, probably for better. But what people can do is they don't need to pick stocks. They can just use an ETF portfolio. Of course, I'm going to say this as well because I run an ETF portfolio. But they can invest in a portfolio of ETFs that might have, like, say, 5 ETFs, 5 to, say, 10 ETFs. And those ETFs are Aussie shares, US shares, emerging markets, or like Chinese shares if you want some spice. It's got government bonds. It's got term deposits. It's all in ETFs, but all held in one thing. So it's a truly diversified portfolio. People don't have to pick individual stocks anymore. And that's what makes it so much less risk for people as they go on that journey. Or you just see a financial advisor, you pay them 5 to 10 grand, they set you up, and you just say, hey, I just want once-off advice. Explain to me how I can use ETFs to do this. And the financial advisor helps you set that up. Probably with the help of an accountant as well, I might say. Because basically what it means, and I showed this in the last few weeks, is a lot of people who buy individual stocks in the past, this is the benefit of diversification. In the past, if you picked just 50 random stocks, some of those stocks would go really well, which is up the top, and some of them would be just absolute dog crap, and they'd be down there. But if you diversified, you basically get the average return. And over the long term, the average return is still positive. But thanks to ETFs, ETFs effectively say there is no best stock, there is no worst stock. You just get all of them in one go. And the average would be somewhere here. And that's why ETFs have become so powerful, and why I think, according to investment trends, I think about 2 million people have bought ETFs in Australia. And I hope that makes sense. But that's what we're seeing. And another option for a lot of people is just put, like, if they're over, say, 55 or 50, they just put more money into super. Finally, I should add something, because this is the foundational episode, is there is tax benefits, and you should speak to your accountant who can educate you. I'm not an accountant, so do not trust what I say in this regard, but you can refer to the ATO website. When you live in a home, one of the big advantages of your primary residence, of your home that you live in, no tricks, the home that you live in, is that typically it's tax-free. So in Australia, it's not unique, but in Australia, it's a very compelling reason why people use property, and then why they pay down their mortgage and then they retire. It's tax-free when they go to sell it. An investment property is not. So, pardon me, sorry. Kevin, you've said, can I ask, if you took $100,000 of equity, can you, 1, claim a tax break each year as long as it remains invested? 2, claim additional tax break of placing it into super? And 3, would you lump sum invest it? Well, Kevin, I cannot give you that type of advice. It is a fantastic question. It's 3-parter as well, I might say. You sound like one of those analysts on one of those quarterly investment calls in the US. It's like they say only one question at a time. And then the first analyst goes, I got a question for you, Randy. It's a 3-parter. But anyway, I joke. basically, the answer is that is the type of advice that you would go to an accountant for. And the reason why I say that is a lot of people get confused about this. And it's not just, I'm not saying that you're confused, Kevin, but just people in general. A lot of people think they need to see a financial advisor to answer those tax questions. You do not. You see an accountant for that. So accountants, tax, they can tell you the tax benefits of super. They can tell you the tax benefits of certain property investments. They can tell you the tax situation of your self-managed super fund. They can tell you that. What they cannot do is they cannot recommend individual investments for you. That's where a financial advisor comes in. Now, a lot of people are confused about this. But if the question that you have or the questions that you have are simple as, hey, I've got an investment property. Can I claim a tax deduction for this? That's where the accountant comes in. Hey, I'm considering if I sold my investment property, what would my tax position be? And could I put that in superannuation as a contribution? Now, you're not actually asking them for their opinion on what investment to make. So when you go to them, you say, you know those rules, and you say, I'm looking for the tax, for you to confirm my understanding of the tax environment. And the reason why I say this is a lot of financial advisors get people coming to them and they just want like a couple of quick answers. And if it's tax related, the best place to go is an accountant. And you might pay a few $100, but it saves everyone's time. And so a good example of this is we had an investor who came to us recently to invest with us. And they just wanted to know, hey, if I sold my investment property, could I invest that either in super or could I invest that, with us? I just need to know what the tax benefit is if I put it in a super fund or if I invested it directly. What's the taxable position? That person found it really hard to get financial advice because the advisors didn't want to just go through the whole rigmarole of charging them $5,000 because of all the compliance and stuff. And so we said, just go ask your accountant. Just go ask your accountant. And that's the best place to go for those types of questions. Sorry for the rant, Kevin, but that's the answer. If you've got a good accountant or a good financial advisor, they can be wonderful at answering those questions and they can come up with all types of wonderful things. Stocks intake. Is it possible to invest in stocks through your super? Sorry, stupid question. Canada has something called TFSA, tax-free savings accounts. Oh, yes, they do, which you can invest or buy individual stocks. Yeah, so stocks intake. There, I would say that you can use something in Australia called a self-managed super fund, an SMSF, which is where it's like a separate. A lot of people get confused what superannuation is. People think it's an investment. Super is not an investment. Super is a tax structure. So super is a tax structure. Whether that's a self-managed super fund where people do it themselves or a financial advisor does it for you, or whether it's the biggest pension/super fund in Australia, being Australian super, it's a tax structure. What happens inside it is up to the people who it's invested for. And if you're with one of the big super funds, they sometimes allow you to go into their member portal and select which investments you want to make to a reasonable extent, or you can just take their default option. Or with a self-managed super fund, you have to pick the individual investments you make. It could be ETFs, it could be shares, it could be whatever. There are pros and cons of both of those things. I'm neither for nor against either of them. So it's just up to getting the right financial advice on that. But yes, the answer is you can have some discretion or control over that. Sam, you said, in my opinion, it's misleading to expect the average market return. The one thing you can be sure of is you won't receive the average. You can be easily underwater for a decade if your timing is unfortunate. Sam, that's true. Like, let's be honest. Trying to time the market, whether you're trying to pick the bottom of it or the top of it, is extremely, extremely difficult. And that's why most people say you can't time the market, whether it's property, shares, Bitcoin, I don't know, emu eggs, whatever. People legitimately try to time emu eggs and all types of weird stuff, and it didn't work. And that's why a lot of the research says if you've got a 20 or 30 year time horizon, to not try and time it and just to slowly just add money over time. And that's the realistic thing. I've fallen down. You said, is Rask Invest opening a superannuation fund? No, we are not. That is something that is definitely not on our radar. It is way too complicated to become a superannuation fund in Australia. And I think the government wants less of them, not more of them. We do have a lot of self-managed superannuation funds that invest with us. They have their own self-managed super fund that they set up somewhere else, and then they come to us and we invest it just like we would for anything. But we don't. To set up your own super fund is like, as in like a big super fund that anyone can use, is very, very difficult, and it's not something that we're interested in. We have a lot of self-managed super funds that invest with us, but we don't have individual. We're not a super fund in itself. I hope that makes sense. So we covered a lot of ground today in property. I just want to make sure that we all understand like some of the key points. Property can be great. People who try and convince you it's property or shares, it should be property and shares. People who try and say that it's like an apples to apples comparison, it's not always. You can do both. The reason that the Australian property market is going up is because of a massive supply-demand imbalance. It's way too expensive to build a property, like to build a house, without significant government regulation, without trade unions getting in the way and trying to stick their beak in, without all of the costs and inflation that was mentioned. The reality is we just need more houses because we have more people. And until we have that, property prices will always face the ongoing pressure of getting more expensive. It's not like, say, the US housing crisis, which was fueled by debt. Our housing crisis is not fueled by debt. It's fueled by undersupply. We don't have enough houses to supply to the people of this country. It's quite different. And there are other ways to invest in property. If we come back to the top of the show, not just residential property, you can invest in real estate investment trusts. As you get older and you have bigger balances, perhaps you can also invest in warehouses. Some people even use their self-managed super fund to buy warehouses or offices and that type of thing. Seek the advice of a licensed professional. If you do want financial advice, we do have a way for people to get financial planning advice. You can follow the get rid of this thing. You can follow the steps that I've laid out here, how to find a financial planner. I've even given you the tools. You can go and see where to check that they are actually licensed, or you can get matched with one of our financial planners if you want to. It's all available on the Rask website. It's totally up to you. But next week, ladies and gents, we're going to step away from this real deep educational stuff and we're going to have a bit of fun. So next Thursday, we're going to talk about adding some stocks to the portfolio, about adding some ETFs. I've got some ideas in my head. I want to look at one US stock in particular. You're going to be like, why are you looking at this thing for? I want to add an ETF. So if you guys have any suggestions about what we can bring up next week, please send them in. You can use the comments on YouTube. It's probably the easiest way. So if you're on YouTube video and see it's just got the comments, just chuck some comments down there and I'll read them over the next couple of days. But another way you can do it is jump into the Rask community. I'll just take this link and pop it in the chat. Jump into the Rask community and just pop it in here. Once you sign in, it's all free. If you go to the events tab on the left-hand side, you can see all of the upcoming events. So you can see like next week's Rask Live. These will all be updated in the next couple of days with the new titles of what we're covering next month. But you can jump in and in here, you can leave a comment of what you want to cover. Let's say you want to cover Starbucks. That's not what I want to cover, but let's say you did, or Costco, or what is it? Wise Tech, WTC, or I don't know, VAS ETF, whatever. You can chuck it in here, and then I'll check that before next week, and we can review them on the live show together. So that will all be added to through not PocketSmith, through Navexa. Don't forget, if you want to sign up and manage your money through PocketSmith, which is what we're doing now, you can do that via the link in the YouTube video. It's in the description area. So that's all just like in this area of the video. You can see all the different resources that we include in all of our videos. There's a link to Perla, there's a link to Navexa, there's a link to Super Guide. You can get some good tools on your side. So that's it. That's all we've got time for today, guys and gals. Thank you for joining me. I know this is like the first 5 weeks of the show has been kind of like just let's sink into the real foundational stuff. But going forward, we're going to talk about what you want to talk about. We've got some guests coming up. We've got some really cool stuff. So don't forget to jump into the community to just give me some ideas for companies and ETFs we can cover next week. That'll be a bit of fun. But that's it for today. Thank you so much for tuning in. Don't forget, if you're going to go down this path of property, debt recycling. It's not for everyone. Get expert advice. See a financial planner. See an accountant, a really good accountant, not just one that does your tax return every year and goes, yep, see you later. Not one of those ones, an actual one that you can call and they respond to your text messages or your phone calls, and get a really good mortgage broker on your side, because I just went through the mortgage broking process with Flint, and now we've refinanced and we've done an equity release. Literally, I just got the new bank accounts last night. So we are in that process, and that's what we're doing. But I don't do that myself. I have experts. You should have experts. It's better to do it that way. You sleep easier at night. Bye for now. I will catch you next week. Thank you to everyone that came along to today's Rask Invest live on Australian property.